What's up, guys? Welcome back to the channel. This is Team Solomon Wisdom, and in today's lesson, I'll be dropping an in-depth lesson on supply and demand. Supply and demand is very important for smart money traders. As a matter of fact, if you learn how to trade using smart money concept, one of the first concepts you're going to learn about is supply and demand. And traders find it very hard selecting the right supply and demand zones to trade from. I've come across a lot of traders who complain about how to select the right zone. So in today's lesson, I'm going to be showing you how to validate the zones you will be trading from. Now, supply and demand trading is crucial for smart money traders because it allows them to understand the fundamental dynamics driving the market price. By analyzing supply and demand zones, traders can identify where the institutional traders are likely to enter or exit the markets. And this helps provide valuable insights about the market movements. Now, one of the key benefits of understanding the supply and demand is it helps identify high probability zones. It helps smart money traders identify where price is likely going to react from. And if you've been following me for some time, this is why it looks like magic when you see me mark out specific areas telling you that if price comes to this area, we're going to see some reactions from there. This is exactly how I do it. Understanding supply and demand areas. Now, understanding supply and demand still helps you understand institutional behavior, just like I stated initially. It helps you understand where institutions are likely going to step into the market. And supply and demand can actually help you combine other smart money concepts to make informed trading decisions. But today, I'm not actually going to focus on teaching you how to mark supply and demand zones. I'm going to focus on helping you validate your zones, knowing the zones that are likely going to hold price. Just like we said, helping you know the ones that has high probability. That's what I'm going to focus in today's lesson. Now, talking about supply and demand markets and how traders map out their supply and demand areas. I've come across many students, and as a matter of fact, different students has different ways they mark the supply and demand zones. And I'm not going to blame them because they come across different traders who teach different things. They show you different things and different methods you can use. And sometimes these methods doesn't really align. One method might tell you something different, so why the other method will show you different ways to do it. But I'm not going to say my method is the best or talk against someone else's method. What I'm basically going to do is show you what has been working for me, because the financial market is all about doing what works for you. If what works for me makes me money, I have to stick with that. And if something someone else teaches makes them the money from the market, they still have to stick with whatever that works for them in the financial market. And while I show you what works for me, I show you life examples and you see why I chose to do it that way. Okay? Now, supply and demand trading. Now, from what you can see right here, this is a demand zone. Why is this remark right here a demand zone? Demand levels are areas where we could look to buy from, just like what we have right here. If price is able to return back to this particular area, what we do is we look to buy from the level because it's what? It's a demand level. Now, in this particular one we have by my right side, this is what we call a supply level. What do we do from supply levels? We look to sell from supply levels. So if in any case we see price coming back to this level, what is anticipation? You anticipate that price is going to continue to the downside. Now, why do we trade from supply and demand levels? Why do we like trading from levels like this? We look to trade from these levels because these levels gives us more like a discount price, just like the demand level. This is a discount price if you want to trade from the demand level because you'll be trading from a very cheap area. Just like this case, let's imagine that you have a bullish bias on this particular example. You want to buy the continuation to the upside. Now, buying from this high right here is not actually the best thing to do because the moment you buy from here, this is a very costly price and you won't really make a lot of money from it. But if you're able to wait till price comes into the discount pricing, it's a preferable area to buy from and you're going to make a lot of money even before price gets to this high and possibly continue to the target you had in mind. Same for the supply level. This is what we call a premium area. Well, when we talk about premium and discounts, it's actually going to break this down. Now, how do we validate supply and demand areas? Just like I said, this is what I'm going to be focusing on in today's lesson. So let's jump straight into that, validating supply and demand areas. Now, take a look at this example we have right now. How do we even know that you marked the supply zone correctly? How do we know that the demand and supply level you're marking is actually very correct? We have some confidence we usually add in this area because a lot of people will tell you if you want to mark your supply and demand zone, look for the last opposing candle to the downside before an impulsive move. Some will tell you that you should wait for a range. After the range, wait for impulsive move to the upside. So if you see something like this is your demand. If you see something like this, it's still your demand zones. This is what a lot of traders will tell you to do. And it's actually very right to do that. But in some cases, having this price action does not really mean that the level is correct because we have some scenarios where we have a lot of price action. Let me give you an example. In a case, we might actually see that range, price react, then we see another range, price react, then we see another range, something like this. Now, seeing something like this simply means that we have a lot of demand levels. In this case, this is a demand because price range and move the possibly, this is another demand, and this right here is another demand. Now, how are you going to know the right one to trade from? This is where the confusion kicks in. Now, I'm actually going to help you filter out some levels with the explanation I'm about to do right now. Now, in this particular case, how do you know that this is a very good level to trade from? Number one thing you need to pay attention to is the range, okay? What's happening in that range or what's happening during that impulsive move to the opposite direction before the actual move to the right direction. Now, take a look at what we have right here. Price was slowing down right here. And after price slowed down a little, what do we see? We have impulsive move out of that particular range. So this is why I marked here as a demand level because it met the first criteria. What is the first criteria? Once price slows down and move away, it's a demand zone. Yes, but what we don't know yet is if it's a valid one or if it's not valid. Now, another important thing you need to see right here that is going to make this valid is the very first thing we have right here, if it has price imbalance, which you can as well call fair value gap or price inefficiency. Now, imbalance is inefficiency between buyers and sellers. Now, once you look at the price action during that impulsive move, if you check the strength of the candle when price impulsively move out of this range, what you want to know is if the candle left inefficiency, if we have a gap right before the point of interest. Now, if you have that gap and you have this zone underneath the gap, this simply means that it's a valid zone. This has now improved the probability of the zone holding price. Another important thing you need to check out is premium and discount price. Now, for your demand zones, price needs to return to the discount area to improve the probability. Now, how are we going to do this? We do this with our FIB tool. Now, measuring from the low to the high of the current price, what can you see? From the 0.5 level to the levels we have down here, these are your discount area. And everything we have at this high right now, this is your premium area. Now, it's ideal that we try to sell from the premium area and we try to buy from the discount area. Why are you buying from the discount area? The discount area, just like it sounds, it's more like a discount pricing and price is very cheap from that area. So in this case, once price pulls inside the range, more like below the 0.5 level, you can look to start buying from there. But another important thing you need to note is the cheapest price is just below the 0.78 level, right? If you see price below the 0.78 level, this is the cheapest price and it's also the best area you can look to buy from. Same for the supply level. In this case, measuring with your FIB tool from the low to the highest point, what can you see? The 0.5 level and above is your premium area. And the cheapest area you could be buying from is from the 0.786 level. Now, if price comes back to this level, you could look to sell from there. Very easy. Now, using your discount and premium concepts can actually help you buy from cheaper areas in the markets. Now, another important thing that can actually influence the validation of your supply and demand zone is your market trend. The trend is actually your friend until it ends. Knowing the directional bias, knowing the trend of the market is very, very important. You're not going to tell me that if price is bullish, you'll be looking to trade from the supply level. No, you look to trade from the demand once price is bullish. And this is exactly what I mean. Once you see price forming series of higher highs, just like what we have here, price is forming series of higher highs in this case. This should tell you that the level you should be trading from is from your demand level. And if you have a shift and price starts to drop, what should you do? You should start looking to trade from your supply levels, right? Once price is bullish, pay attention to what you have at your demand areas because they are the best points you could look to trade from. And once you spot that price has shifting structure, then paying attention to your supply levels will be the best thing you do. Another important thing is understanding your higher time frame directional bias. The higher time frame bias is actually very, very important, especially if your supply and demand zones aligns with the overall trend of the higher time frame. It has higher probability and possibly is going to hold price. So all these concepts I've been able to break down in these few minutes. I'm going to explain that using a live example, just like the one we have right here. This was a trade I had with the VIP students on GBP AUD. This was on the 30 minutes time frame. And I'm going to show you why and how we spot this trade opportunity. This is the exact same trade opportunity when price got to a profit target. And this was the trade when price was offering about 3%. Okay, so I'm going to use this example. This is actually the very same trade I had with the community. This was the very first setup. This is actually a student results. This is from Mr. Victor. He's a student in a VIP community. So he actually took the trade from the supply. He also got involved from the one from the demand. So I'm going to show you how this was done because these two trades, we spot them during our live meetings. Even though I was able to take only one of these trades, I'm going to show you how we built ideas to get that trade opportunity. So this is GBP AUD. This is the 30 minutes time frame, and I'm going to show you how we were able to build that trade ideas, how to spot supply and demand areas, and how to validate that the zone you're actually trying to trade from is a valid zone. And I'm going to start doing it from this particular area we have right now. Talking about supply and demand areas, I said you have to spot price inefficiency, and you do this by the strength of the candle. Once you see a very strong candle, be it bullish or bearish candle, try to spot inefficiency. It plays an important role. Take a look at this particular area. You see we have strong bearish candle moving to the downside at this particular area. I hope you can clearly see that this is a strong bearish candle dropping to the downside. Yes, price also moved from a range because this is actually a good range over here. So price left the range and dropped to the downside. A lot of people will mark here as their supply level. Okay, this level could be marked as a supply level. And if you take a look at it, price came back for the mitigation and it dropped, respecting that. This is a typical example. But in my book, I'm not going to mark this as a valid zone in this case, talking about zone validation. It's not a valid zone in my book. Yes, it met a lot of criteria. If I try to zoom out right now, what is the trend of the market? The market trend is bearish, price is moving to the downside, and it meets one of the criteria. Another criteria we had is talking about premium and discount area. If you measure with your FIB tool, measuring from the high of the range till the low of the range, you can see that that particular level aligned with the premium level, but it's still not a valid zone. Why is this not a valid zone? Now I'll try to zoom in so you could see clearly. This zone doesn't have price inefficiency. Yes, we have big candles, but we didn't have an inefficiency right here. This alone disqualifies this from a high probability zone. But from what you can see, the level was able to hold price and it played out perfectly. That's why I said what I don't stand with might work out for someone else. It doesn't mean what the person is doing is wrong. It doesn't mean I'm wrong. What I focus on is doing what works best for me. So someone else might mark here as a zone and a valid zone. And if the person trades from here, you see the person making money from the market, while I didn't choose it as a valid zone and I missed making money from there. So this is one thing you have to understand about the financial markets. People focus on doing what works best for them. So my advice for you is this: stop the arguments and do what works for you. Now, taking a look at the second zone, and from what you can see right here, the second zone is exactly my kind of setup because price swept liquidity above this high, moved with institutional candle, taking the candle strength right now. And you can see this particular one left inefficiency. You see, we have this very gap right here, and this automatically makes this a valid zone if I want to mark it right now. Selecting this bearish candle we have down here as my demand zone. This is a very, very good point of interest because it aligns with the trend of the market and it meets all the criteria that makes it a valid zone. Now, if you pay close attention to what we have apart from the level we just marked right here, you can agree with me that we have a market structure shift around here. You see price breaking above this particular high right now. This is a valid market structure shift. And if you try to look at the candle strength right now, you see we have big candles moving to the upside. It was able to break structure as well, and it's actually moved out of a range because this was a slow price action. Now, if you're struggling to understand what a range means, a range is what? A slow price action, an area where we see price slowing down. And after price slows down, we see price moving out with a big candle. And this is exactly what we have right now. This was actually a range, and after price range right now, it's moved out with a big candle. It was able to break structure as well. Now, is this a valid zone? Yes, it's also a valid zone. But why are we not paying close attention to this? The trend of the market is currently bearish. This is a clear bearish market. But one of the things that gives us confidence right now is we have a market structure shift right here. So the market structure shift we have right here gives us the confidence that, okay, something can possibly happen around this particular area. But let's press price forward and see what we have right now. So from what you can see right now, price came back inside this demand zone. From what you can see, it's already mitigates the zone. Now, playing price forward to see, price starts to move. Now, came very close to the level we have right here, very close to the supply. It couldn't get to it. Instead, it starts to drop again. Now, pay close attention to what we have. We have a very good demand zone right now. Price came back for the mitigation and it moves to the upside. Now, this particular one met the criteria, but the only thing that was kind of missing in this particular trade is the trend was bearish and we just had a market structure shift. Yes, market structure shift means we will start anticipating a shift in the trend of the markets. That's exactly what it means. And over here, you can clearly identify that price broke structure again, and the right area we could look to mark a good zone was somewhere around this particular area. Marking a zone around here is actually a very good idea because price is now aligning with the internal trend, because what we see right now is price is breaking internal structures and possibly you might start seeing a shift in trend from around this particular area. But the only downside with this particular trade opportunity we have right now from this level is it doesn't have price inefficiency, but it looks good. It meets other criteria. The only thing missing right now is it's failing to present price inefficiency in this case. Now playing price forward. Now, boom, what can you see? Price came, mitigates the zone, and we have a very good reaction to the upside. Hope you can see that this is simply how to mark your supply and demand zone. But this particular example is not valid in my book. Why? It doesn't have price inefficiency. This is a very good demand example. And we still have the supply level we have over here, and price is actually taking some time to return to this particular level. Now, playing price forward. Now, finally, price came to mitigate the supply. And now that price is mitigating the supply, every smart money trader will have one expectation. The expectation is that price is going to react from this area, at least take out the sell side liquidity. This is exactly every smart money trader's expectation in this case. But let's see what happens. Now price starts to react from the level we have some drop to the downside. And if we want to look at this from supply and demand point of view, we see we have another good demand area in this case, because we have that range again where we have a slow price action. Price moves with candle that has momentum. This is where we have price inefficiency. And if you mark this area, it's a good zone as well if price comes back for the mitigation. But in this case, price is actually moving from a supply, and trading from here could be a little risky in this case. What I'm doing is pure analysis. I'm not doing this based on emotion or the trades I took. I'm doing pure analysis considering supply and demand zone. So this is a very good demand zone, but currently price is reacting from a supply. And if price comes back to this demand, it might not hold price because the supply is a little bit stronger in this case because it aligns with the bearish order flow. But from what you can see in the internal structure is shifting bullish. So framing a bullish idea in this case is not totally wrong. But let's press price forward and see. Now, price couldn't get to the demand level we had. Instead, it continues higher, breaks above this supply level. Now, this confirms that price is actually shifting in structure because it now breaks above this particular high. Now, trying to mark the next demand zone based on the confluence we have, you see, this is actually a very good demand zone to trade from. It looks good, and you see we have a gap right here, and you see this demand is more like at the middle of the range. Personally, I don't love trading this kind of demand zones because I focus at the extreme levels. Now, using the fib tool to make sure that this demand zone aligns with your discount level. Now, measuring from the low of the range to the high of the range. Now, what can you see? This zone is below the 0.5 level, but note I said the 0.78 level is actually one of the strongest, which might align maybe around this particular area. So this particular zone is still valid, but note it has low probability. You can't compare it with the extreme level. Okay, now what we have to do right now is just to pay close attention to what price is doing, because how price moves and what price does in the market is very, very important. Now, playing price forward. Now you see price continues to the upside without getting to the last two demand levels we have. Now, we still need to pay attention to price because you see price has shifted bullish right now. Price is bullish, and looking for your bullish trades is going to make a lot of sense. Now, at this particular area, we start seeing some bearish momentum kicking into the market. You see this bearish movement dropping to the downside, and I'm able to spot a good trade right here. As a matter of fact, as of last week, I was looking at this particular trade, but I didn't take the trade, and I'll tell you why. Now, at this particular area, what we see is that price sweeps this high, price takes the high, breaks internal structure, and it drops. Do you believe that we have a very good supply level around this particular area? This is a very good supply level, and if you try to check, it meets some of the criteria. One, this supply, it has price inefficiency, which you can clearly see right here, because looking at the strength of the candle, we have about 3 bearish candles. These are big candles. Secondly, this particular price is at a premium level, right? This is at a premium level, and we can look to trade from there. And if you try to look at the higher time frame bias, because what you're looking right here is actually the 30 minutes time frame. If you go to the higher time frame, the higher time frame bias is bearish. That is just the truth. If you try, well, let's see the 2 hours time frame. So this is the 2 hours time frame right now, and what can you clearly see? The 2 hours time frame is clearly bearish. I hope you can see that the 2 hours time frame is bearish. Price is dropping to the downside, and currently price just came in contact with a very strong higher time frame zone. This is a higher time frame supply. Price hits a higher time frame supply. That's why we were seeing that movement to the downside. That's why we saw price reversing immediately to the downside. So framing your trading ideas around the higher time frame bias is very important. But based on what we were seeing on the 30 minutes time frame, I wasn't really satisfied. Let's drop to the 30 minutes time frame. So this is the 30 minutes time frame, and I said I wasn't satisfied with the price action. Yes, you saw price sweep liquidity, break internal structure. Why am I still not satisfied with trading from this particular valid supply level? Now, the only way I can trade from here is if price breaks underneath this low, because this is actually the strongest low we have right here. If this move we had was able to break this particular low right here, believe me, I would have taken this trade, but instead it broke only internal structure and I wasn't satisfied with that. But let's see how price reached low price action. Now price returns back to this particular zone. So you see, this now gives me the confidence to frame a bearish bias in this case. Price mitigates the supply, drops to the downside with what? With very big candles as well. And you can clearly see the price inefficiencies, seeing the candle strength, and you see this particular price action now aligns with the current trend, which confirms that price has actually shifted in structure, which is something we saw right here. This was the very first area we saw that shift in structure. And when we saw this shift in structure right here, price starts to trend to the upside. Now, over here, we've been able to identify a strong shift in structure as well. This should tell you that you should be framing your bearish bias in this case. Now, where is my supply level? This is my valid supply level, and this was the exact trade opportunity you saw me share to the community. The one I showed you before I moved to the price chart. This was how I spot that trade opportunity, because one, price was reacting from a higher time frame supply, which aligns with the higher time frame bias. Secondly, the directional bias in this case has shifted bearish. Thirdly, this level is from a premium area and we have price inefficiency considering the candle strength. This was how we spot that trade opportunity. But from what you can see, price has now break underneath this supply. You see, this supply was not able to hold price. And from what you can see, price spikes underneath this demand level, which tells you that we can now start anticipating bearish movement from this particular area. Now playing price forward. Now, finally, price came back to the level and it mitigates our point of interest. And this is the exact point I pulled my trigger and I have my profit target around this particular low. And this particular trade, I made 4% from it. Now take a look at the price actions we've had so far. Price has been presenting good trade opportunities, but I was actually waiting at the right moment. So this should help you understand as a trader, even though you see the whole price actions, wait for the one that has higher probability and the highest probability before you pull the trigger. If I actually took the trade from here, I would have made money because I spot the trade opportunity. If I took this one from here, I would have made money as well. The only one I approached in all these trades is the supply we have right here. I tried to take a trade from here where I lost money. Price actually offered some reaction to the downside before the reversal. So I lost money trading from this particular area. Now, I still took my time to analyze the market, saw this, I didn't take it, waited for this one, and this one meets all the criteria. Then I pulled the trigger around here. But price also presented another opportunity in case you miss taking the trade from the very first entry, playing price forward. Now you see price came back into the zone, and once price got to the zone, what did we see? This is price breaking above this particular high. Now let's see. Boom, from there, price reversed. And price reversing means we have an internal break right here. So since price broke internal structure right now, if you're a very smart trader, you should just wait for price at this area, because all this has now aligned with the bearish trend. It means that we start seeing bearish movements from here. Now playing price forward as well. See, price came back for the mitigation of that level, and you see how it dropped from there massively. See, mitigates the level. Now, in the space of how many days, we have the mitigation of this, and price has now mitigated three supply levels. I hope this explains it all, and I hope you've been able to know how to validate the strength of your zone, know if your zone is strong, and if you're actually trading from the right zone. So personally, I took this. It offered another confirmation, which I didn't take, but we've seen the power of supply and demand areas, and price actually hit my profit target in this case. Now, the very setup I was actually showing you that a student took in the community. Firstly, he took the first trade from the supply, and he equally took this one from this demand, which is currently reacting to the upside. And someone is going to ask, why did he take the trade from there? Personally, if I wanted to take the trade, because from the 2 hours time frame, you will see the inefficiency we have right here. And another important thing you need to do is, since price is bearish and it's risky trading from this zone directly from here. What you basically do is just wait for confirmations, which is exactly what price presented right here, because we have a shift in structure around here. And from what you can see, price came back to mitigate another demand zone around here. Hope you can see that. You see the candle strength moving to the upside, reacting from a demand. Here is more like a confirmation. And if we try to play price forward, price starts to move away from there. Okay, see that price starts to move away, and this is the current price action today, being the 27th day of September when I'm recording this video. The last candle closed on 26th actually, but I'm recording this video on the 27th day of September. Okay, so I believe with this particular illustration, you've been able to understand how to trade supply and demand levels and how to know the one that has higher probability. If you take a look at this price action, we have a lot of supply and demand areas. But the most important thing is selecting the ones that has higher probability. Yes, select the ones that meet criteria and the ones that is valid. I hope this lesson answers some of the questions you have about supply and demand. And if you still have any more questions, you can drop them in the comments and I'll try to attend to them after now. So thanks very much. This is still me, Solomon Wisdom, and see you in the next lesson.